Over to you, Raph. What do we make of the labour market numbers?
I mean, the key takeaway is that it's been unchanged basically since about April, right? And that easing that we're hoping to see, or the RBA is hoping to see, is yet to materialize.
Yeah, that's right. I mean, it was a good news, bad news result. So the good news was we had an unemployment rate that stays stuck at 4.1%, which is admirably low. That was the third consecutive month on a seasonally adjusted basis. If you look at the trend numbers, we've been at 4.1% for 5 months, starting in June this year. So despite everything, the labour market has remained pretty tight. The underemployment rate even edged down. We're down at 6.2%. We were 6.3% in September. So on that side of the numbers, there wasn't any sign of the loosening that the RBA has been looking for. And I guess we could maybe just to remind that listeners, if you go back to the August 24 edition of the Statement on Monetary Policy, at that point, the unemployment rate was, surprise, 4.1%. And according to the S&P, that remained below estimates of the rate consistent with full employment. So that's the rate the RBA thinks is consistent with getting inflation back to target. And then we got a speech from the RBA Assistant Governor Economic in September. The speech was understanding the journey to full employment. And then according to Sarah Hunter, the current assessment was that the labour market is operating above full employment, but has moved towards better balance. At that point, the unemployment rate was at 4.2%. So the RBA doesn't really like 4.1 or 4.2. It thinks the labour market is too tight.
We got the minutes from their last decision, of course, was to leave rates unchanged. Now, they did talk about, well, I guess the three scenarios moving forward with regards to what their decision on interest rates would be, being up, down, or not at all. In more detail, what were some of those scenarios and what are the factors going into those scenarios?
I guess if we start with, I think, the least likely first. So the scenarios for a rate hike were that supply capacity in the Australian economy turns out to be weaker than they thought. And again, this is something we've talked about a few times now, that if productivity growth, output per head continues to disappoint, then the RBA has to rethink what it thinks is potential growth, the strength of the supply side of the economy. That might mean that capacity assumptions are different than they thought, and that might mean that they need higher interest rates. If they decided that for whatever reason, inflation was likely to remain above target even longer, I think they're basically saying that 2026 is sort of the limit of their patience. And if the forecast starts to push it out beyond that, then you start to worry about things like de-anchoring inflationary expectations, and they might feel compelled to do an increase. That's interesting because that, if we just a couple of minutes ago said the world's pretty uncertain, there's a potential for shocks. Normally, you expect central banks to look through shocks. One of the things they're saying there is that if they got an inflationary shock, given that inflation has been away from target so long already, they might not be prepared to look through it. They might actually have to respond with a rate increase. And then the third reason for the scenario is if we talked about that they thought that current policy stance was restrictive, but they weren't quite sure how restrictive it was. If they ultimately decided actually the current stance is less restrictive than they thought it was, then they might have to adjust policy accordingly and tighten. So they were the three scenarios for rate hikes.
Quickly on the last one, I mean, earlier you just talked about how maybe they were being the labor market targets were too high. So can I take it then from your perspective, it's unlikely that you think they're being overly loose with the interest rate?
Yeah, I think that's right. I mean, I think that if I would look at those three scenarios, the one that I would worry about the most would be an adverse external shock. I think there are some sort of medium-term concerns around the productivity story. That would be a surprise to anybody. But in terms of it being a short-term justification for a rate hike, I think that's unlikely. So yeah, the one I'd be watching there is that the nasty external surprise.
Okay, number two, scenario 2 is rates on hold forever.
So this brings us back to our old friend household consumption. And the story here is the RBA, I guess for the last sequence of forecasts, has said there's lots of uncertainties around what's happening with consumption. If it recovers faster and stronger than the RBA currently thinks it will, the RBA forecasts have penciled in kind of a modest recovery. It does think consumption growth is going to pick up as we go forward, but it's a sort of a modest, steady increase. If it turns out to be much more robust than that, then that will be a case of leaving policy on hold. You're not going to cut into a consumer boom, basically.
Yeah, of course. Which brings us really to the scenarios in which they cut the rates. Now, we've been talking every week. It's actually my new favorite segment is Mark's February rate cut prediction. I might read a couple of headlines for you on the rate cut. Well, actually, first I'll start with the RBA themselves. Scenarios in which inflation declined materially more quickly than currently forecast could warrant an easing in the cash rate target, but the board would need to observe more than one good quarterly inflation outcome to be confident that such a decline in inflation was sustainable. And then some media headlines that I guess are interpreting that line amongst others. ABC headline from Tom Crowley, RBA says February rate cut not guaranteed even if inflation figures rosy. And from NAB, we now expect the RBA will start cutting rates in May 2025, brackets previously February. How are we feeling about the February rate cut?
I wouldn't say it's dead, but you could say it's on life support or maybe hanging by a thread.
I mean, that line that more than one good quarter,
it makes it difficult, right? So if we talked about the three scenarios that the RBA put in place for a rate cut, so one, again, our old friend consumption, so that the flip side of the consumption recovery turned out to be stronger than expected, as it turns out to be much weaker than expected. In other words, consumers really start to pare back their spending. That's potentially a case for a cut. Second one, the labor market eases more sharply than expected, but we just talked about the labor market numbers and there's not really much sign of that yet. And the third one was that surprisingly good news on the inflation front, but that it needs to be more than one quarter. And the timing, therefore, starts to look difficult. So the next RBA meeting is the 17th to 18th of February. The next CPI reading, so the Q4 CPI, is due out on the 29th of January. So that did allow time. If you got a decent Q4 CPI reading, that allowed us to get my February rate cut. But if you need more than one quarter, the next one, the Q1 2025 release, doesn't come out until the 30th of April 2025. The next RBA board meeting after the February one is on the 31st of March, the 1st of April. So it'd be too late for that. The one after that is the 19th to 20th of May. So if you think that the only way that we're going to get an RBA rate cut is two surprisingly good quarters of CPI inflation, then you basically now have to pencil in May for a rate cut, which, it's not good news for my February call. The only thing, the only little bit of hope that I was left clinging into from the minutes is they did have this section where they talked about that they were going to switch to become a little bit more forward-looking. So we've spent... We developed these catchphrases over the course of over a year, and one of them has been data dependent. I did it. The RBA is data dependent. In other words, it looks at the data and then decides what it's going to do. And by definition, that's a very backward-looking approach. You're waiting to see the numbers. The numbers come with a lag. Again, listeners, and another phrase that I've used often on this podcast is that it's like driving by only looking in the rearview mirror. You're seeing where you've been, but you're not looking at where you're going. And there's a section in the minutes which says that members recognize that it was important to be ready to adjust the future stance of monetary policy as the economic outlook evolves, and that it was important to remain forward-looking, avoiding an excessive reliance on backward-looking information that might lead the board to react too late to a change in economic conditions. So there is a slight out there, I think, still, that you could move before the data move on their own.